Gold lost its glitter for investors. This after a bull run up to $900 an ounce. Today it was down $17 an ounce. It's still pretty healthy at $885, but again off of that 900 mark and pretty far off of that $1,000 mark. Should you buy on this dip, or are gold's best days behind it? Mike Norman and Peter Schiff are back now to debate it. Mike, first to you. Lost its glitter, gold?
It never had any glitter. It never had any glitter. Look, if an investor bought gold in 1980 at the last time when we had this big cycle in inflation, that investment adjusted for inflation right now would be down almost 60%. In other words, you would not have recovered your money. By the same token, stocks, the Dow Jones Industrial Average adjusted for inflation is up almost 600%.
Okay, I'm watching the time. I'm going to give you each about the same amount of time. Go ahead. I may stop you, Peter. Go ahead.
Let me go. Well, first of all, 1980 represented the end of the bull market. The bull market began in 1970 when gold was at $35 an ounce. And back then, the Dow was worth 20 ounces of gold in 1970. Right now, the Dow is worth 14 ounces of gold. So if you bought gold when it was cheap, you did better than the Dow.
Okay, hold on. Back to Mike now. Go ahead,
Peter,
Mike.
do you know why gold was worth $35 an ounce in 1970? Because it was pegged there. It wasn't allowed to trade freely. And then when it was allowed to trade freely, there was a time that it caught up. It's like if you have wage and price controls. Peter, if you took the time...
Hold on. Each go. You've got another 5 seconds.
If you took the time from 1973, where gold started to trade into the hundreds until now, guess what, Peter? It still returned less than stocks.
Peter, go ahead. Is it a good buy now?
Yeah, look, give you a little background. Back in 1999 and 2000, Mike and I were both bulls on gold when gold was under 300. We didn't have a lot of company. A couple of years later, when gold got to about 400 to 500, somewhere in there, Mike Norman turned bearish. He's been bearish ever since. I've been bullish. We'll see what happens. He made a little money in the beginning. He's left a lot on the table. I think gold's going a lot higher, and I'm sticking with
Mike,
it. And it glitters for me.
Go ahead.
Are you saying in the last 2 years...
Don't ask questions. Just make your point.
Look, you could have bought Google and seen it going up 10 times in value. You could have bought Apple in 2006 and seen it go up 5 times in value.
Hold on, Peter.
You could have bought Research in Motion and seen it go up multiple times more than gold. Peter, let's face it.
Mike,
gold is a bad investment. It's even a bad inflation hedge.
No, it's not.
It's not even an investment. It's a speculation, and that's it.
Peter, go ahead.
Gold is outperforming other asset classes. You can find individual stocks. Sure, you could have bought Xinjiang gold mining in China, and that's outperformed every single stock that you mentioned. I'm not talking about speculative gold stocks. I'm talking about an asset class. And gold is outperforming stocks as an asset class. It will continue to do that probably for another 5 or 10 years.
Mike,
so you can be oblivious to that, but I'm going to profit from it.
In the last 2 years, yes, it's outperforming the averages, but if you want to do this, we could go back and forth all day. I just gave you several examples of stocks that would have trounced gold.
Those are stocks. I can give you all kinds of gold stocks that did better than those.
Peter, let's look at gold over a long history, my friend, and I could tell you this, and the data absolutely supports this, that gold has been a terrible, terrible investment.
Let me ask one question.
One question
of Mike Norman,
and when you sell it.
Peter, hold on. One question.
Yeah.
Why did you turn bearish on gold when it was at 400?
Because I felt it became very speculative, and yes, I got out way too soon. And sometimes, look, Warren Buffett, he bought what is it, PetroChina, and he said it was a market cap of $30 billion, and he got out when it went to $120 billion, and guess what? It went to $300 billion. That's Warren Buffett. I don't profess to even be anywhere near as smart.
And Peter, I got to tell you, I had a Krugerrand that I bought at $300, which was I knew it wasn't going to get much cheaper than that. I sold it at $600. I could have made a couple of $100 more, but I feel pretty happy about a doubling of my income, shouldn't I?
Well, it depends on, what happened to consumer prices. A lot of people think they're making money if they have more dollars, but the dollars might have a lot less value. Gold is a good asset to own at certain periods of time. Gold was great to own in the 1970s because of the inflation we created in the 1960s, and gold was great to have owned in the 1930s. It's going to be great to own gold for many, many more years. But you're right, Mike, I'm not going to keep my gold forever. At some point, I'm going to buy up assets when they're very cheap, and I'm going to get good dividends on very low-priced U.S. stocks.
Mike,
but right
now,
I
can say, look, you could go back to 1929 until now. The stock market has returned about 6.5% compounded annually.
But
gold has returned about 4.5% compounded annually. Peter, gold pays you nothing. Wait a second, Peter. Gold pays you nothing. There are no dividends. It pays no interest whatsoever.
Mike,
It's a pure speculation. To buy it at $250 was a prudent thing for me because it was below the cost of production. Now it is a wild speculation, and people are going to get burned. I can assure you.
In 1929, the Dow was worth 20 ounces of gold. It's worth only 14 today. It's gone down.
Because gold was at a fixed price, Peter. You don't understand. If it
but
wasn't
it was
at
a real
fixed
price. We were on a gold standard. Gold was money.
But if it
gold
wasn't,
was the same price for over 100 years.
If it wasn't at a fixed price, it might only have been, 4 ounces to the Dow, and then it would be now whatever 6.
Mike, you got to wake up to reality.
No, the reality is you can't make that analysis when gold was held down artificially in price.
No, it wasn't held down by anybody. We just didn't have a central bank printing a bunch of money.
But you had the government that said you could only exchange dollars at a rate of $32 per ounce of gold. That was a fixed price. It wasn't allowed to appreciate.
No prices were going up. We didn't have any inflation back then.
If you keep a commodity artificially low because of some kind of constraint or wage or price control, and then you allow it to float, it's going to reach a new equilibrium
I agree,
level.
Mike. That happened during the 1960s.
And you can't go back to that time when it was held down.
Hold on, he's agreeing with you. Go ahead, Peter, on the 1960s.
Look, that's true in the 1960s because we ran these big deficits. We created a lot of inflation while we were still on the gold standard. That's why we had to close the gold window and go off the gold standard because of the irresponsible monetary policies of the Federal Reserve during the 1960s. All right,
guys, we started with Mike. We're going to end with Peter. That was about the most instructive discussion of gold I've ever heard from either one of you. So thank you very much.
You're welcome.